All right, my friends, so let's look at some bond funds, shall we? Because I was going to get down the whiteboard and show you the graph of how bonds work, but instead I had a number of people say, how about bond funds or ETFs? So let's dive into that here. All right, so we're going to start with the Vanguard Ginnie Mae fund, which is one of my favorite bond funds. And just to give you an example, back when I was at Vanguard in 97, 98, 99, Ginnie Mae was paying about 6.25. And I always said, and this is where I started realizing how bonds are different. I said I would put $1 million in the Ginnie Mae and live off the interest. That'd be about $62,000 a year once I hit 65. Literally, my goal was to have $1 million in Ginnie Mae and just live off the interest. Lo and behold, though, if we go to the summary of what Ginnie Mae is doing now, I think it's paying 2.8 something. Let's see here. Current yield is 2.87 exactly. So you're not living off $1 million. Isn't paying you $62,500 anymore. It's paying you $28,700. So that's what a 65% decrease in income that you have. Not good. And so, and even worse though is that you had that $1 million. If you would have invested it in 1997, it's still worth $1 million today, but it isn't paying you. It's not, your purchasing power isn't $1 million. Your purchasing power has dropped probably by about a half. So that $1 million is really only buying you about $500,000 worth of goods today because of inflation. So even though you started making $62,500, then it starts going to $60,000, then now it's down to $28,700, and that's literally how it works. So let's take a look at we'll see what their performance has done, and let's see. So we're going to look year to date is up 5.36. So far this year is up 5.36. And the only reason for that is simply because of the interest rates having declined. But you're not, well, let's just keep going. Let's see, right here, last year is up 0.87. The year before, 1.87, 1.85, 1.33. In 2014, it jumped a little bit to up 6.65. The only reason for that is because the year before that it was down. I think that was the first time it was ever down, actually, 2.23. 2%. Now, government bonds had some appreciation here because people were still fleeing to quality for sure after the 2008 and 9 debacle. But still, you can see 7.6, 5, 7, 7, 4, 3, 3, 4, 2. And the reason for this is because the interest rates have been driven down. I mean, I love Ginnie Mae, don't get me wrong. But the facts are you aren't going to get more than whatever the coupon is, right? Well, the yield right now is 2.87. Just because, and here's a 5-year average return, 2.11, which corresponds remarkably similar to that of the 10-year Treasury. Isn't that amazing? 10-year Treasury, 2.11, 5-year average return. And there you go. In fact, let's look if we let me pause it real quick. This is the U.S. Treasury Department. We can get the rates on historical rates on the long or any bond from a Treasury bill to the 30 years. So let's look at it again. 5-year return of the Ginnie Mae is 2.11. Let's take a look at 5 years ago what the 10-year Treasury was doing, shall we? So we're going to go to that'd be 10 years. 5 years is going to be 2014, and we're going to hit go. And the 10-year Treasury was trading at, September. We'll just say September 2014. And we'll go down. And by the way, here's a 10-year Treasury. It's on this graph right here, the third column from the right. So September 2014, the 10-year Treasury was trading at 2.45. I mean, look at that, 2.45. And what did the 5 years returns? 2.11. I mean, that's... And yet you can say, hey, I got 5.36, but you didn't get 5.36. You gave some of it away in 2013, you got negative rate, and then 2014, you got a positive. But at the end of the day, you're only getting what the rates are of the treasuries. I mean, look at that. So you got 10-year Treasury, 2.46. And that's literally, if you would have bought the 10-year Treasury, you would have got 2.46. Now, Ginnie Mae is a little bit different because it is a mortgage-backed security. But this, I just want to show you, you're not getting more or less than the rates of the yield at the time you buy it. So let's look at BND. Let's look at what's the Vanguard. Let me pause the Vanguard Government Bond Index Fund. We'll see what that is. Here's a Vanguard Total Bond Index Fund. Now, about 65 to 70% of this fund is in treasuries and mortgage-backed securities and government agencies. So it should be pretty close. And look at that, 5-year annual return, 2.13. Why? Because we go back to the treasury and we see The 10 years 2.46, the 7 years 2.14. And I bet if we look, so here's a 7 year, just FYI, 7 year, all right? So if we look in September 5 years ago, the 7 year Treasury was paying 2.14, I think is what we said. Let's take a look. 2.14. I bet if we look at the average maturity, it's going to be right around 7 years or so. Let's see if it shows us. I don't even know if it shows us anymore. I stopped paying attention to this much. Let's see, average maturity. We want to go to summary. We might have to go to Vanguard to see that. Average return, beta, yield, your previous close. It doesn't say the average maturity there. All right, hold on a second. Let's go to, we'll have to go to Vanguard, average maturity. Yeah, okay, so let's just go to Vanguard and see. Let's see here, risk. It should be here. How can they not have average maturity on here, man? It's crazy. Yahoo, I tell you, man, I like the reason I like Yahoo is because they give you the performance, and I like this year over year. You don't find that very often other places, but they don't give you much more than that. All right, so let's go to the Vanguard website, just real quick. Profile. Is it profile? Oh, maybe it's holdings. I think it might be on the holdings. Looking for average maturity. Bond equity holding bond maturity right there. Look at that. Average maturity 8.2. I mean that's so essentially you're getting the equivalent in this case of a now this is a little bit different too because it does have some corporate bonds in there. But you're getting a little bit, you're getting a duration, well, I don't want to say duration, you're getting a maturity, 8.2 years is your average maturity. And if we look at the 7 year, that's what it's been doing. About we'll say 7 to 10 year maturity is most bond funds, 7 to 10 year average maturities. So you look at anything between a 7 year 10-year treasury, a 7-year treasury, and a 10-year treasury, 2.11 to 2.42. That's exactly what you got for return. That's literally exactly what you got for return. It's that simple, man. Now look at let's see if they show you on this. About, like I said, 70% of this are going to be government bonds. You got Fannie Mae, Treasury. Look at that, Treasury, and then the rest will be corporate bonds. I'm wondering what just real quick, when I'm thinking about it, the duration. So a quiz. I told you about this video yesterday. I did a video on this yesterday. If interest rates go up, or I just should say, how much will your portfolio drop on this account right now? If interest rates go up by 1%, how much will the price drop in the portfolio? All right, so the total bond index is trading at $11.18. Let me get my trusty calculator right here. It would drop by the amount of duration. If interest rates go up by full percentage point, this portfolio will go from 11.18 minus duration 6.02. So it would go down to $10.50. So you lose about 67 cents a share. All right, so let's go to what else do I want to do? Let's go to corporate. We'll go. So I think I proved my point there on government bonds. So government bonds very, very easy to understand. You're saying, look, I'm getting the equivalent of whatever it is the yield today. So if the yield is the average maturity is well, let's take a look. Average maturity today in 2019 on a 7-year Treasury bond is going to be, the average maturity, average yield on a 7-year Treasury is 1.5 and 1.55. So this guy right now is paying, you're going to get today, if you hold this for the average maturity, which would be about 7 years, you're going to get between 1.5 to 1.55%. Now you probably get a little bit more than that because there are some corporate bonds in there. And I can hear you saying, but Josh, how can you say that when the current yield is, 2.63? Well, it's simple, because they have bought some bonds that are still in their portfolio that were issued 5, 10, 15 years ago that had a higher yield, a higher coupon when they bought them. And so those bonds are going to mature, and that's where the average maturity comes into play. So these bonds are going to mature, and inherently the yield is going to go down because they're going to be replaced by bonds that are being bought today. I cannot stress this enough how important this is to understand. So their yield is 2.63, and that's all you're getting. All right, you're not getting any more than that because you already have those bonds in play. But as those bonds mature, and if their average maturity is 7 years on this fund, I think it's 8 years. There's a whole bunch of bonds that are maturing here every single day. A whole bunch of bonds that are maturing. In fact, you can even look at the prospectus. Let's do that. Hold on just a second. Let's look at the prospectus. I wonder if we can find it here. All right, so here is the total bond index funds annual report, not the prospectus actually, or not the statement of additional information. It's the annual report. And you can see they got Treasury Agency 43%, government mortgage backed, that'd be Fannie Mae, Ginnie Mae, Freddie Mac, 22%. So we got 65% in government sponsored bonds without question. That's actually lower on the lower end. I would have thought it'd been about 70%, but still 2/3 of the portfolio is in mortgage-backed agencies and treasuries. But anyway, let's just keep going down. Look at this, all right? But so, look, these are all the holdings that they have. And so you can look, maturity date 2020. So they have a bond right there with a coupon of 2 5/8, 2.625. Well, that's going to mature in 2020, all right? So in 2020, that's going to mature. What are they going to do with that? Well, they're going to have to, in fact, they have $853,000 in that fund. So when it matures, they're going to have to turn around and buy this right here is paying 1.5. Actually, this is 1.5 for the 7-year Treasury bond, or 1.55 for the 10-year Treasury. All right, then they got this other one, U.S. Treasury note bond is paying 1 3/8. It'll mature next year, so that's probably a shorter term bond. They got this guy. Let's see here. 2021 paying 2 3/4, 2022 paying 2%, and so you can see they got 3 1/8 right here. That's not maturing until 2028, so they still got 9 more years to let that guy give them 3 1/8. Not too shabby, but if we had a 9-year bond, I mean, you can look. Let's look. That's a 9-year bond. We'll even say it's a 10-year bond. A 10-year Treasury bond. Ready? A 10-year Treasury bond. What's a 10-year Treasury doing right now? 1.55. All right, so if a 10-year Treasury right now is paying 1.55, and this essentially is the equivalent of a 10-year Treasury at 3 1/8, 3.125, which is more valuable. Both these bonds mature in 10 years. Both are 100% guaranteed by the federal government. Both have no risk at all. One is paying 3.125 and one is paying 1.55. Which would you rather have? You would rather have the one paying 3.125. How much would you be willing to pay a premium for the one paying 3.125 as opposed to the one paying 1.55? It's a mathematical equation. I'm not going to do it here, but you can easily figure out what the going price on that 3.125 will be. It'll be more than your bond that's paying 1.55, everything else being even. That's how the bonds work. So I don't know when Vanguard bought this, but they got $620. Got to check on my little buddy back there. $623,000 of bonds at a 10-year Treasury, but this wasn't a 10-year Treasury when they bought it. Maybe a 20? I don't know. Maybe a 30-year. I don't know, but it's paying 3 1/8. In fact, we can probably go back. Let's see here. So that was a 10-year Treasury. Let's go back to the yield curve, shall we? 3 1/8. So we haven't had anything paying that in the 30-year realm. All right, so that's got to be, they probably bought that 10 years ago, I bet. Let's see. Let's go to 2010 just for giggles, shall we? And I'm looking at a 20-year bond. What was 20-year bonds doing back then? It's still pretty high back then. So 20-year bonds paying 4.5. I bet they bought this. 20-year bonds, there's 3.9. I bet it's a 20-year bond, maybe even a 30-year. Let's go back to 2001. Let's see what the 30 years were doing back then. 2001. Yeah, I'm not sure. So I don't think it'd be a 15. Let's go to 2013. Let's just get a gauge. I mean, it could be a 15. I mean, the federal government. Oh, there you go. 3 right there. It's probably a 30-year bond in 2013. No, that's not it, because that wouldn't mature until 2043. So that wouldn't be it. But a 20-year bond. Let's see a 2008. What's that? Because it's going to mature in 2028. Let's see what a 20-year bond was doing in 2008. Maybe there's a 20-year bond. It's still a little bit on the high end. I don't know. Either way, it's I just want one other thing here real quick. Hold on just a second. When did the Fed cut? They raised in 1999. Let's look at 2002. I'm just curious to see what that was. Let's see what 2002. All right, so I don't know what the maturity when they bought that, but it's not maturing until 2028. Definitely not a 10-year bond. Maybe it was. Let's take a look. Maybe they bought it. But see, if I recall back in May of last year, yeah, I think it might be a 10-year bond. They probably bought it in May of last year. Let's take a gander. Back in May, there we go. Again, 2.7, 3 right there. Yep, 3.11. There you go. So it's a 10-year bond they bought in May of last year. That's what it was. All right, so what happened was they had a bond just like this guy right here that's getting ready to mature in March of next year. And they said, and at that time, they're able to redeploy that money, that $796,000. Oh, this is great. So they're able to redeploy that into this 10-year bond that's paying 3 1/8, just because the interest rates at that time were 3 1/8. Now the interest rates have been half that in the course of 15 months. Crazy. Oh man, look at that face. Oh, this is great. So here, let's go. Let's look at this 3. Oh, here we go. Perfect example. All right. Guarantee that 10-year bond that they bought in May of 2018 is worth a heck of a lot more money than they paid for. I guarantee it. Let's take a look. This is it. So we got a 10-year bond at 3.125. They bought in May of last year. It matures in November of 2028. And let's see, they paid $623,000 for it. How do we know that? Because that's the face amount. That's the face amount. That's what it's going to mature at. And it's worth $647,000. I guarantee that bond is worth a whole lot more than that today, because this is as of the end of December 2018. I guarantee this probably thing, I don't know what it is right now. We'll say 680. Guarantee it 680. Well, we can factor it. Watch. So if the bond end of the year is $647,000 and the Treasury market is up 10% this year, 647 times 1.1 is trading at 711 right now, $711,000. So they got so they bought it at 623. And I'm gonna assume that's the face. I don't know if they bought it at par. I don't know if they bought it at issuance. I just don't know. But let's just assume they did. So that's their par amount. It's not gonna be that much off it. So the 623, they could sell this bond at 623 that they bought at 623, or that will be the face amount. What the maturity amount will be. They could sell it today for about $700. Let's say $700,000. They'd have a $75,000 capital appreciation. Well, what did they do with that? Well, they're looking at new 10-year treasuries and they're saying, yeah, I'm only getting. I'm curious what November of last year did, real quick. November 2018. Yeah, there you go. November 2018. It's up to, there it is. So, okay. They bought November 2018. In fact, I can almost guarantee you this guy matured 11/15. They bought this sucker right there. 11/14, 11/15. They bought, look at that. It's a 10-year, they bought it. So anyway, what happened was from November 2018 to December, the interest rates went down. Here's your 10 years, 3.11 when they bought it at November 14, 2018. At the end of the year, went down to 2.69. At the end of the year, when they did this annual report, the face value, which they purchased for the bond, was 623 at the maturity date, and yet they're still worth 26,000 more than that. Now it's worth a hell of a lot more than that. It's just because the rates have gone in half. Oh, there's my little buddy over there. All right, cool. Just got to check on my big boy over there. So let's see. Let's take a gander. I would be surprised. Here's one where the face amount is more than the market value. All right, so here we go. And this guy matures in February. So what's going to happen here, my friends? You see the face amount. So look at this. It's 1 3/8, 1.375, and matures in February 2020. Has a face value of $858,000, a market value of $846,000. So what that means is that's a essentially, well, you say it's a 1-year treasury as of 2008, about 2018. 1-year treasury. 1-year treasuries were paying right here. 1-year treasuries at the end of the year were paying. Let's see, keep going down. 2.63, significantly higher than when Vanguard bought this. So no one is going to buy their 1-year treasury at Vanguard at par value, aka face amount. No one's going to buy that. They're saying, look, if you want to offload that 1.375, when I could turn around and go to the treasury market right now and get 2.625, you're going to have to sell it to me at a significant discount. And you'll see the discount right there. $858,000 face amount. The market value as of the end of December is $846,000. And by the way, this is mark-to-market accounting. This isn't, but this is how mark-to-market accounting works. The market value at the end of the year, or the market value whenever the FASB, the Financial Accounting Standards Board, says, well, your mark-to-market value, you have a face amount of $867, but you only have a market value, let's say $750,000. Oh my goodness, that means you're way under your loan to value or your debt to equity or equity to debt, however you look at it. You got to raise capital to get your ratios better. And they're like, if I sell all this stuff at mass, it's going to bring more supply drops the price. It's only going to hurt more. Yep. That's if I can find a buyer. And there's no buyers, I have to sell it at basically pennies on the dollar, just like Joe, the car wash guy. Anyway, so that's a 1 year. Let's take a look at paying 1.375. So this guy matures in February of 2020. So that's going to be it's got a 6-month bond essentially. Yeah. So let's take a look. 6-month Treasury bonds right now. What are they doing? Let's take a look. 6 months Treasury bonds right now. See how this is fun, isn't it? I love this stuff, man, because it can show you how this works. 6 months Treasury bond right now. Here's 6 months. 1, 2, 3, 4 columns from the left are trading at 1.88, so still higher than we thought. That's higher than we thought. So basically what's happening here is a 6 month is still trading more than this right here. So this, I'm actually surprised by that. That's the inverted yield curve right there. So the fact that 6 months is trading more than the bond that Vanguard has of 1 3/8 would tell me that this bond will still be lower than the face amount. You still have a market value less than the face amount, but each and every month as it gets to maturity date, this 846 will slowly, steadily get to the 858,000. It depends on if they bought it at issue or not, but just that's how it works. All right, so those. Let's see what else we got. Do you have anything maturing in 2019? You get to 820. So this one will mature right here. Let's see, a year from now. 1.5 and a 1 year bond. That's actually, again, that's less than what you're getting now in a 1 year bond. And so what you'll see here, yeah, exactly. So this is less than what you're getting right now in a 1 year bond. So this will be selling for much less than the face amount just because you're getting more than 1 year bond in a new issue today than if you were to buy this one off Vanguard. And here they got a one in 2048 at 3 1/8. So they bought that last year, 2018 at 3 1/8 right there. All right, so that's a long term. That's long term. Here they got 1 1/8 that's maturing in 2021. And I hope you get all how this works here. You got $84 million, or is that in billions? That might be billions. Here's 1 1/4. Anyway, so what's happening? Just going back to what's going on here. I'm just curious. I just want to see if they got any corporate, but they show us our corporate bonds. Hold on just a sec. Because this is the total bond index. And here's the ETF. Why don't they show the corporate bond holdings? They should. That was the treasuries. Why don't they show the... I'm just curious what kind of corporate bonds. They not have to disclose that or something like that? Let's see. Well, I don't. Maybe they just... I don't get that. Why don't they show the corporate bonds there? They gotta show the corporate bonds. What page am I on? Oh yeah, 39. All right, so let's go back to the top. This bores you? Sorry. And let's see here. We want to see the holdings. Hold on a sec. Come on, get that guy out of there. There we go. I'll go this way. All right, cool. Light up, everybody. Well, oh, there we go. Sweet. You know who that song is? Light up, everybody. Welcome to... How'd that song go again? It's from Styx. Remember old Styx? They were freaking great. Fannie Mae. Look at all those Fannie Mae's. All right, so here we got a Fannie Mae 3.895. Date of maturity 2042. That's long-term bond backed by mortgages. Fannie Mae, Freddie Mac, non-gold pool. No idea what that means. Ginnie Mae. Ally Auto Receivables. Don't know what that is. Auto Receivables. Interesting. I wonder if that's for Ally Bank doing floor plans for car dealers. I don't know. That's interesting to me, though. Maturity date, face amount. So here we go. Here's a Freddie Mac paying 4 point, we'll just say 4.5. Matures in 16 years. Face amount is $646,000. Market value is $678,000. Guarantee the market value is much higher than that today because you're not getting anything Freddie Mac at 4.475. That's got an 18-year maturity, or was that 16-year maturity? Yeah, all right. I think I'm done with this. I just got this. Okay, there's a Capital One. All right, so Capital One multi-asset execution trust. Man, that just scares me. That sounds like a communist. We're going to execute people. You got Chase issuance. Look at that. Citibank credit card issuance. Who knows what? Here's a corporate bond right here. 1.8 is maturing in 2 years. But you can see right here, look, I mean, you can go through this. The market value and the face amount. Market value, 10,200. Face amount, 10,300. Market value, 993. Face amount, 94. Anyway, all right, so I guess that's all I want to show you. But that's how bonds work right there in bond mutual funds. Just because a bond fund has thousands of bonds in there doesn't shield it for the basic mathematical economics of the bond market. You still got the same issue. As interest rates drop, the price of bonds go up, but it doesn't matter because at the end of the day, that price of the bond's going to go down back to get the par value. It's literally that simple. I hope this helps. I'd love to hear your comments, so put them down below. Thanks, guys.